What's good, traders? Let's get right into the triple Qs because this market is at a very important spot right now. Now, we're in the continuation phase, and the real question becomes, can buyers keep control without the market pulling back into some of these gaps below? So let's start with the daily chart first. On the daily time frame, the triple Qs are still clearly bullish. The market exploded off those April lows and has been putting in aggressive higher highs and higher lows ever since. Buyers completely reclaimed momentum. But now we're reaching a different phase of the move. The market is getting stretched. And one thing traders need to understand is, when markets move this aggressively without proper pullbacks, they leave inefficiencies behind. Basically, price moved too fast. And those areas underneath current price eventually become magnets later if momentum slows down. Right now, there are multiple gaps and imbalance zones sitting below current price. The biggest short-term concern is the gap structure between roughly 705 and the 690 area. That doesn't mean the market has to crash tomorrow, but it does mean downside volatility can accelerate fast if buyers lose control of momentum. So from the daily perspective, bulls still own the structure, but risk increases the further price gets extended away from support. Now let's move into the 1-hour chart. This is where things get more tactical. On the hourly time frame, buyers are still defending pullbacks very aggressively. Every dip lately has been getting bought quickly. That's important because strong markets don't usually collapse immediately after breakouts. They typically consolidate first, and that's exactly what we're seeing right now. The key area on the hourly chart is 710. That level matters because it's acting like momentum support right now. As long as buyers continue defending above 710, the trend still favors continuation higher. But if 710 starts failing cleanly, then the next draw on liquidity likely becomes 705. And if 705 loses, that's where those lower gaps start becoming much more relevant. So the market is bullish, but it's balancing on momentum now. Now let's drill down into the 5-minute chart because this is where execution matters most. On the 5-minute time frame, price is no longer exploding vertically. Instead, we're seeing compression and rotation near highs. That usually tells you one of two things is happening. Either buyers are building for continuation, or momentum is slowly exhausting before a pullback. Right now, buyers still have the edge because breakdown structure hasn't confirmed yet. But this is not the place to emotionally chase candles. That's how traders get trapped. So here's the execution play for the next trading day. If price pulls back into the 710 zone and buyers defend it again with strong reaction candles, that's the higher probability long setup. The stop would go below structure failure, not random points. An upside continuation could target the recent highs again near 714 and above. But if 710 breaks aggressively and price fails to reclaim it, then I would not force longs there. That's where the market could start rotating lower towards 705 and potentially begin working into some of those open gaps underneath. So the biggest thing traders need to understand right now is this. The triple Qs are still bullish, but the market is becoming increasingly dependent on buyers defending momentum. And the more gaps left underneath price, the bigger the risk becomes if momentum finally snaps. So don't chase emotional candles up here. Let the market come into your levels. Let price confirm direction. And stay disciplined with execution. Stay sharp. Ciao.